stay here. I'm sorry. I'm going to try to do it, but you might have to hold it. It's going to be hard to hold it. Oh, fabulous. Thank you. Okay. Oh, just, can people hear me okay? Okay. I'd like to thank you for inviting us to talk here today. We would especially like to thank your fellow club member and President-elect, John Snow, for making sure for arranging us to come to today's meeting. We're very grateful for his time and effort in making the arrangements, as well as the detailed instructions on how to get here, and we actually arrived early. And also give a bit of a chance to look at around the Lamb's Farm facility and do a little purchasing, and it's quite a nice place that you have your talks here. And the question that many people are asking today as the markets gyrate around them is, what is going to happen? How can I invest? How can I invest and save for my retirement? Well, my co-authors and I have a distinct message about the market, and we say Dow 15,300 by the end of 2010. Now, we know that may be a bit difficult for you to swallow at the moment, with an unstable manufacturing sector, deteriorating business conditions, sluggish consumer spending, serious slack in the labor market, and for those of you who are realtors, I know about that market isn't doing too well either. It really is tough to make a good case for buying stocks. But as my co-author Lawrence Rosenberg, former chairman of the Chicago Mercantile Exchange, will tell you, that's exactly the reason why you should buy. As a former trader, he says, remember the old adage, buy low and sell high. My other co-author, Neil Weintraub, who is sitting with me here today, has noted that the combination of runaway inflation on commodities, such as oil, will warrant adjustments by the Federal Reserve Bank, and with a number of Federal Reserve rate cuts coming to an end, the dollar can't go that much further down. And we believe that exchange-traded funds are the best way to take advantage of a rising stock market over the long term, because they offer low management fees, are tax efficient, liquid, and diversified. And basically it would be a shame, as we say, if the Dow goes to 15,300 if your stocks were not on board. And the way to make sure is to be invested in a broad-based exchange-traded fund, because statistics reveal that individual stock pickers rarely come out ahead, which is why we believe in exchange-traded funds and why we wrote this book. Before learning how to use ETFs, I'd like just to clarify exactly what ETFs are. ETFs, or they're formerly known as exchange-traded funds, are investment funds that track the performance of a particular stock index, such as the Dow Jones Industrial Average or the Standard & Poor's 500. The Dow Jones Industrial Average, which you always hear about on the radio, basically tracks the performance of 30 of the largest companies in the United States. The Standard & Poor's 500, which is more diversified, tracks the performance of 500 of the largest companies in this country. And there are more and more indexes every day. You can use them to invest in all sorts of areas. But an ETF is basically tracking an index. An investor who buys 100 shares of an ETF called the SPDR, which tracks the Standard & Poor's 500, basically winds up buying fractional shares of all the stocks in the index. And those stocks are held in trust by a trustee of the fund. So if you buy 100 shares of the SPDR, you're getting roughly 4 shares of ExxonMobil, 3 shares of GE, 2 shares of Microsoft, and a lot of other pieces of the American economy. Although they're similar to mutual funds, ETFs have certain features that set them apart. One is ETFs trade like shares of stock throughout the day. This means you can buy or sell your ETF at any time of the day. Mutual funds, however, you can only buy or sell at the end of the day. And also, unlike mutual funds, you can sell an ETF short. so you can attempt to profit from a fall in price, which you can't do with mutual funds. Basically, ETFs are bought and sold just as shares of stocks. That's the key point there. But there's a major difference between ETFs and a lot of mutual funds, which some of the salesmen here may not want me to talk about, but I think you need to be aware. Benjamin Franklin once said, "A penny saved is a penny earned." Actually, when you count taxes in, a penny saved is a lot better than a penny earned. Say you earned $1,000 on an investment, okay? Or you had a choice of saving $1,000. Say your tax rate could be 20%. So you have the chance to earn $1,000. $200 is in taxes. You only have $800 now. Whereas if you would save that money, the government does not tax you on savings. You would have had the equivalent amount of money. And that's very important when comparing different types of investment funds, because costs vary, and ETFs tend to be much cheaper than a lot of other investment funds that are out there. One reason is they're very efficient in terms of taxes. Who out here owns mutual funds? Who got a tax bill last year for funds they didn't sell? Okay? This is a certain problem with many mutual funds, because the managers like to trade, and when they sell the pieces of the portfolio, even though you haven't sold your mutual fund, you're paying taxes because capital gains were incurred by the fund. ETF owners very rarely pay capital gains taxes unless they sell the fund. I mean, these events do happen periodically, but it's very rare that an ETF holder will be paying capital gains taxes until they sell their product. Of course, dividends, as with mutual funds, are taxed the moment you receive them. So that's one advantage ETFs have over many mutual funds. Another advantage they have is the area of costs. And in the first chapter of our book, we give a simple example. Consider two investment funds. They both earn 8% per year. However, one has an expense ratio of 0.20%, such as